All right, hello everybody. This is Mike Rixey. I am the lead options instructor for Netpicks, and this is our options trade of the week. Over the last few weeks, we have seen a pretty impressive run to the upside, which has left a lot of stocks overbought. In last week's trade of the week, we took a look at selling a call spread on AMD, which is Advanced Micro Devices. We're going to go back to the well here this week. We're going to stick with the short call spread, but this week we're going to go with eBay. We've got a lot of markets that are incredibly overbought, desperately in need of a pullback, but we've seen no selling to speak of over the last few weeks. It's been a very strong market. If I wanted to be neutral to bearish here, well, if I wanted to be bearish, I could just come in and buy a long put. The reason I don't want to go to that strategy here today, the only way I make money if I buy a long put is if that stock makes an immediate move to the downside. It's got to be a big enough move. It's got to happen fast enough. Otherwise, I'm going to lose money. Since this market really has not given us any type of a sign that it's ready to head lower, I do want to lean a little bit bearish, but I'm going to do so in a way where I have a neutral kicker as well. And let me walk you through what that looks like here. Here's a chart of eBay. This is the 195-minute chart. It gives you 2 candles a day instead of 1. Just speeds up that daily chart here a little bit. You can see the run to the upside that I just got done talking about. This market has seen an impressive run higher, and a lot of these stocks that we like to trade have participated in the move to the upside. A lot of the NASDAQ names have been really, really strong. You can see just over the past 24 hours, we've started to see a little bit of a topping pattern come into play here. Price action slowly starting to roll over to the downside. One of the indicators that we use down towards the bottom of this chart is what's known as our pulse indicator. That is the red, yellow, and green histogram that I'm circling down there at the bottom. What that indicates to me is when we're getting to overbought or oversold extremes. Notice just recently on the right edge of the chart, we got a series of yellow bars and one green bar. That green bar is the one that piqued my interest for this short call spread. And what that stands for, it's going to plot green if we have between a 2 and a 3 standard deviation move on the upside. Now, some of you might not be familiar with standard deviation. It's a statistical term. Basically, what we're telling you here is when we get to between a 2 and a 3 standard deviation move on the upside, in this case, oftentimes you're going to see a period of consolidation or even a reversal to the downside. It doesn't mean it has to fall out of bed. It doesn't mean this stock has to collapse. It just means in the near term, we're overdone. And oftentimes when you start to see at least one green bar on the pulse indicator, oftentimes it's very, very close to a market turn. So that's what piqued my interest for selling a call spread here. And let's go over to the trade page and let's piece this trade together. What we did is we went out to the July 19 monthly options. Those are the options with 36 days left to expiration. I'd like to go a little bit farther out in time here. We're going into historically a slower time of the year. We've got vacation season ready to kick in. We've got a holiday shortened week upcoming with 4th of July. Amazing that we're already talking about that. But we're most likely going to see tighter intraday ranges, a slower market, and by using the monthly options, it gives me a safer position. It allows me to hold the trade longer just in case the desired move that we're looking for on eBay, in this case a move to the downside, just in case it takes longer to develop. Now we went in and we decided to sell the 40-42 call spread, and what that looks like. It has me selling the 40 call. So I'm going to right click on that 40 call. I'm going to go to sell and I'm going to select vertical. It's going to pop up an order down at the bottom where I'm selling the 40 call and buying the 41 call at the same time. But I'm going to make one small adjustment here. I am going to buy the 42 call instead. Buying the 42 call puts me in a risk-defined trade. A lot of times people get intimidated by the credit spreads because they think they're really risky and going to tie up a lot of capital. It's just not the case. By putting on this $2 wide call spread, again, it's a neutral to bearish position, but look what it does for me. Right now, this thing is currently trading for 61 cents or $61 per spread. I'm risking $139 to make 61. At initial glance, that doesn't look like a great ratio, does it? I'm risking 2 to make 1. Why would I want to do that? Because I have so many ways of making money on this trade. My break-even point is at 40.61. You can see it in my order confirmation box here. That number is calculated by taking the 40 strike that I'm selling, the 40 call option that I'm selling. We're adding in the 61 cent credit that I'm collecting to put the trade on. That gives me the break-even at 40.61. I don't care If this stock moves up, down, or sideways, as long as it stays below 40.61, I'm okay. Remember, I want to lean neutral to bearish here. I want the stock to move lower. With the stock currently trading for 39, I can be wrong by $1.60 and still make money on this trade. The only move that hurts me is a big move higher from here, which I'm not expecting. The market's already overbought. We're already between a 2 and a 3 standard deviation move to the upside. So now I make money if it moves up, down, or sideways. I make money if the time decay adds up. So every day that passes, I make money from the time decay adding up. And I make money if volatility decreases. So I give myself 5 different avenues to make money from. That is the beauty of a credit spread. We all love to buy calls and puts. If the market's active, it's exciting. There's a lot of profit potential there. But having a mix of different strategies that we can go to is going to benefit our P&L. It's going to give us a smoother equity curve over time. Because if the market gets slow in the summer months, I don't have to force one strategy to work. I don't have to force the market to move to make money. If the market moves dead sideways, if it moves slightly against me here on eBay, I can still make money. Is it the home run profit potential? No. The most I can make on this trade is $61. However, the most I can lose is $139. So do I have a smaller profit potential? Yes, but I've also got a very reasonable amount of risk. You can put this thing on multiple times. You could put it on 10 times and you're still talking about less than $1,400 of risk. So a lot of flexibility here regardless of account size. We'll track this one going forward. We'll see if we can get a market pullback over the next few weeks. It doesn't have to be a huge one. If we just sit dead sideways here, we can work with that. But we'll see what happens here on eBay. If you have any questions at all, feel free to post a comment on the YouTube video. You can leave a comment on the blog, or feel free to contact me directly. My email is mike@netpicks.com. All right, so I'm going to wrap this video up here. We'll be back next week with you all. We'll take a look at our last couple of trades from our weekly our options trade of the week, and then we'll take a look at a new trade as well. All right, so thanks for watching, and we'll talk to you guys here next week.